Hi, my name is Yerdal Namazali and I'm from Hellebury, Almaty, Kazakhstan. And this is my video for the case study. This first slide frames the whole case. Brighttech is an European software company focused on manufacturing automation. So, mission critical tools that sit deep inside factories and logistics. The company wants a 30 million euro loan to do two things in parallel: enter Asian markets and push AI driven research and development so the product stays ahead of its competitors. You can see the pie chart at the center. Roughly half is for the Asia rollout, about a third is ring fenced for research and development, and the remainder is a working capital buffer so execution doesn't starve day-to-day operations. That split already tells a story. This isn't patching a hole, it's a financial growth with a safety net. My starting view, shown on the right, is conditional approval. The analytics in the next slides explain why and the conditions I want to attach so we keep risk contained. On the left, you've got 3 bars for revenue with slimmer bars for EBIT and net profits. The picture is consistent. Top line has stepped up each year and profits have moved with it. What matters to lenders is not that it just grew, but why? The text box below calls the out last year. The company intentionally leaned into spending to prepare for Asia and to develop the AI roadmap. That created a bit of margin pressure, but it's investment led, not deterioration in the core business. Look at the small table on the right. Year over year, growth stays positive across revenue, operating profit, and net profit. That's the kind of resilience we like to see when a borrower is about to take on more execution risk. In short, the commercial engine is working, and management is already behaving like an expansion stage team spent upfront to gain market position. Now I switch from performance to defense. Can the company handle bumps? The four gauges make it simple. Liquidity first. Current and quick ratios are comfortably above 1, which means short-term obligations can be met without scrabbling for cash. Leverage next. The debt to equity gauge sits in the moderate zone, so there is room to borrow without over-gearing the balance sheet. Interest coverage is multiple turns on EBIT, so lenders aren't relying on perfect condition to be repaid. The table at the bottom shows working capital discipline. Receivable days are steady. Customers pay on time. Inventory is a touch higher as they build for Asia, and payables are slight shorter, which I read as suppliers having normal power with no distress signals. Over on the right, you'll see OPEX as a share of revenue nudged upward. That's consistent with pre-launch spend we just discussed. The conclusion line across the bottom sums it up. Adequate liquidity and coverage before the loan, with efficiency a little tighter because they're gearing up. That's exactly why the structure of the loan matters. We keep liquidity strong while the plan converts into revenue. This slide answers the credit committee's favorite question: does profit turn into cash? The table shows a clean staircase, operating cash flow rising year by year, capex that's disciplined rather than aggressive, and positive free cash flow throughout. The cash line at the bottom confirms it. Cash on hand builds not because of one-off tricks, but because the core business throws off cash. On the left, I highlight earnings quality. Operating cash consistently exceeds the accounting profit. That tells us we're not relying on optimistic accruals or one-time items. Dividends are present but measured, which is exactly what you want in a company preparing for a big push. For the credit decision, the message is simple. This is a borrower that serves debt from cash, not hope. That gives us confidence to lend, if we pair it with the sensible controls. Here I translate the loan into post-deal metrics using conservative market-level assumptions. Think mid-single digit interest, a 5-year term with even amortization, and a phased draw over 12 months tied to milestones. Look at the tables on the right. After the loan, leverage steps up to a normal growth loan range. Interest coverage softens but remains in the comfort zone, and liquidity increases because we add cash up front. Visually, that's exactly what you want to see for an expansion. A bigger safety cushion today while revenues and margins catch up tomorrow. The key design choice is the phase drawn down. It aligns cash out with real progress. Hit the Asia milestones, unlock the next tranche. Pause or slow down if milestones slip. It's simple, and it keeps risk symmetrical between borrower and lender. This page maps risks to controls, one for one. With those protections in place, my final decision is conditional approval. The company's growth and cash conversion justify the loan. The structure keeps its risks contained, visible, and adjustable. I always ask, what breaks this deal? This slide shows three paths. In the base case, Asia contributes meaningfully by 2025 and earnings grow at healthy double-digit clip. Leverage and coverage both stay inside our rails, so the loan behaves exactly as we designed. In the pessimistic case, Asia slips by roughly a year and RD hits only part of its targets. Here, we feel the stretch, but the covenant guardrails and phased draws do their jobs. Spend slows, cash is preserved, and we keep room to correct course. In a deeper stress, coverage drifts towards the floor and leverage toward the ceiling. That's the red zone, where our yearly warning triggers fire. We stop the new tranches, escalate monitoring, and, if needed, re-underwrite the plan before more capital goes out. The monitoring list on the right is deliberately short. Quarterly Asia reporting monthly cash controls and the early warning flag if results deviate materially from plan. Simple processes get followed, complicated ones get ignored. To wrap up, BrightTech is using depth the right way to accelerate incredible expansion while maintaining discipline. We get a portfolio exposure to a resilient tech vertical, a business with solid profitability, a track record of converting profit into cash, and a management team already invested ahead of growth. My recommendation is conditional approval with 4 pillars: phased drawdowns, clear covenants, quarterly KPI reporting, and temporary dividend limits. Process-wise, it's standard. Committee sign off, finalize documents and covenants, complete due diligence, sign, and then fund against milestones. The slides behind me hold the evidence. The structure puts the evidence to work. With these conditions, this loan is a measured bet on growth with contained downside. Thank you.